I'm not going to ask you a stock pick because I know that those are a bit of a secret, but I do want to start off a bit bigger picture. As we said, Japan is really going to be centre stage perhaps again this year. You've called Japan perhaps the most underappreciated turnaround story for global equities. Does that mean that you see further upside in the rally from here?
Yes, we do. So we do think that Japan is probably the most underappreciated story in the global equities. This year, Japan has just exited deflation for the first time. There is a healthy amount of wage increase, about 5% this year, and also some moderate amount of price inflation. Now, this positive cycle of wage increase and price inflation leads us to project a nominal GDP growth rate of 2 to 2.5% for Japan for next 2 years, which is very good. On top of that, we also see corporate governance reform in Japan. So the Japanese corporations used to have very low ROEs. Back in 2013, it was about 4% ROE, and then it has increased to about 9% as of last year. We project that through share buybacks and cross-shareholding sales, this ROE can increase to 12% by the end of 2025. Now, this sustained ROE increase can lead to a re-rating of Japanese equities, in our view.
A lot of investors had really been optimistic about Japan, and we have seen big inflows into the market, and we have seen a big rise in stocks as well. If you're saying it's the most underappreciated opportunity, does that mean you're seeing a significant upside potential from here, given there's already a lot of investors that are bullish?
We do think there's a lot more upside from here. We think this regime change in Japan is actually sustainable this time. I think every 10 years or so, people tend to get excited about Japan and it's faded away. But this time, because of BOJ's efforts in getting Japan out of deflation and raise interest rates to the positive territory, we think that the wage increase and the price inflation is here to stay. And as well, we think that the re-rating is going to continue to happen in Japan, which will lead to further upside for Japanese equities.
The other theme, which is quite intriguing, is the idea of Chinese domestic brands going global, right? EV is actually one example that you make. It's obviously under a lot of pressure from Western markets in terms of the overcapacity claims. Do you mean that, you know, the dominance of Chinese EV brands, for example, will be in markets that are not in the US and not Europe?
Yeah, Heidi, we do think that if you look at the Chinese domestic consumer brands such as EV, 10 years from now, out of the top 10 EV companies, we estimate that 5 of them will be Chinese. If you look at the product competitiveness, you look at the supply chain cost advantages, we think that the speed of that happening would actually be faster than the market believes. Obviously, there is a lot of tariff worries that we have to watch out for, but given the cost advantages are more than 50% compared to a lot of the global players, even with some level of tariffs, we still think that the price difference and the advantages still here to remain.
At the same time, though, and I understand that these two things are perhaps not mutually exclusive, there are concerns about the overcapacity issue for you?
Yes, so one of the sectors that we're cautious about is the manufacturing sector in China. We think that there may be potential overcapacity in the Chinese manufacturing sectors, and there is a path to downsize in the next few years. For example, China accounts for 18% of the global GDP, and its share of the global investment is an astonishing 32%. If China's GDP were to grow at 4 to 5% for the next decade, China will become 21% of the global GDP in 10 years. And its share of global investment will grow even more to 37%. This means the rest of the world will have to reduce its own share of investment by 1 percentage point to accommodate China. Can the rest of the world absorb such an increase? Well, we think U.S. and EU has already voiced the concerns about trade imbalance with China, and U.S. has already launched various measures to move manufacturing back home. So we think it may be very challenging for the rest of the world to continue to consume more while allow China to manufacture more. Hence, we think China's manufacturing capacity may have reached a peak, and there may be a need to downsize for the next few years. And that has very profound implications for credit growth, consumption, and global supply chain.
Can you share some insights into hedge fund thinking or strategies in this region as well? Because traditionally they've been sort of long biased, and given what we've seen in Chinese equities in particular have really underperformed of late. So do you see that trading strategies are needing to shift as a result?
Yeah, Annabelle, I think that's a very good question. We did see that in the past 10 years, a lot of the Asia hedge funds have been riding on the positive beta of China. And now that the beta has turned negative for the past 3 years, some of the performances have been challenging in the sector. We think that given this new world order, volatility have increased, and the next generation hedge fund managers do really need to show alpha generation on both long and short side. For example, at Sigmoid, we evaluate ourselves on alpha generation versus our benchmark, MSCI Asia Pacific, on a quarterly basis, and our goal is to achieve a larger than 5% of alpha generation on a consistent basis. So I think in future it is important for a hedge fund manager to demonstrate alpha generation and strong risk management.